All right, so here they are. These are the people who know what's going on in this business. And before I ask any questions, does anyone out there have a burning question that they've always wanted to know about stop loss, or something that has happened to you recently that you want to address before I launch into this? Because once I start, it's hard to get my attention. Nobody has a stop loss question. Oh, of course, Vic's got one. Oh, there's one of them. Vic, you're going to go second. There's one in the back.
So I'm an employer in Denver, strongly considering going to a RBP program, ATM machine, and I wanted to know a little bit about your opinion on the impact of that on stop loss premium, and also whether you all work with RBP administrators, and if not, why not?
All right, yeah, Johnny, you want to go?
In short, it works from our standpoint, and there are absolutely first-year savings, no question about it. I think you're going to see ROI pretty quick, but we definitely give a decrement. So if we quote it one way, assuming RBP through HST, for example, versus normal PPO, you're definitely going to see some price variance in the positive. So,
Pete, you got it?
Yeah, I used to think that the conversation for reference-based pricing is what he's referring to, right? Yeah. I used to think it used to be just for the select few, but I think that everybody should look into it. I think if you poll all of us up here, we'll tell you that the top 10, 8 out of the top 10 stop-loss claims we have today are in-network claims with BUCA networks. And because of the outlier provisions, everybody know what an outlier provision is? That means that we could be getting 50% discount out of the gate, but because the claim hits a dollar increment, let's say 500,000, instead of 50, we're now getting 25. And once that claim hits 750,000, instead of 25, we're getting 10. And that's back down to $1. So we've had multi-million-dollar claims that are in network where we're getting 10% discount. You don't have that with reference-based pricing because there is no provider contract.
Yep.
So.
Unfortunately, I said unfortunately, more often than not, those outliers sit at about $90,000 or $100,000. So we lose the discount really quickly. I think RBP is definitely proving to be very effective. I would say that most of us up here are getting more and more confident with those types of programs every day, and with our confidence and our underwriters' confidence comes more and more discounting for those types of programs and the implementation of them.
The math is pretty simple. When you have hospitals billing 600 to 900% of Medicare, and you can get an HST or some of the other vendors to get 160, 170% of Medicare, you can do the math. It pays. We've had situations where a $100,000 spec, we had a $200,000 claim, and it ends up not being a spec. That's big for us.
And big for the client ultimately
Absolutely.
at renewal time.
I think to answer your other question of does anyone not do it and why, we're all friendly competitors here. You do it. You do it. We all do reference-based pricing. For how long we've been doing it is probably different for each carrier up here, but it's obviously something that we're very proactive in pricing. And as Johnny said, there are significant discounts. So if you've got a sophisticated administrator like Cypress and you're willing to try something different, then I would definitely suggest going with reference-based pricing, at least to see what the savings can be.
I think it's, if I'm bullish on reference-based pricing like most, and I think a lot of you make the mistake in saying, well, I've got my PPO contract here and it's the same as my reference-based pricing quote, the numbers are even. Well, the exposure on the large claims is really what you're buying on the reference-based pricing side because the exposure isn't the same. So it's worth it for me, even if the dollars are the same. Your risk tolerance and corridor is going to be much better on the reference-based pricing than it is on a PPO contract. So even if it's dollar for dollar, it's still worth it, in my opinion.
There you go.
And as Adam was just saying, I mean, everybody has been doing this in varying degrees. I think a lot of times it's the territory of where your client is. Maybe it's more prevalent than others. But, if you have this thing, why maybe you may not want to do it. A lot of times it's the broker hears that more so than us, but it sometimes I think come down to maybe a fear factor of will my employees be balance billed and will that go away? And because you don't want someone pounding on your door saying I owe $100,000 and they just need to trust the process. So I think there's maybe a fear of that some clients and brokers say, you know what, nope, I'm not going to do it.
Yeah. All right.
I would say that all RBP providers are not created equal. also.
Can I just ask another question on top of that and just kind of expanding a little bit on what Alec was asking? And maybe you were touching on this, and I don't know if this is where he was going, but if an employer is looking to move to that from a current PPO situation, now I think, Pete, you might have been just saying a little bit on dollar for dollar. Are you talking about, like, what could, if you can answer, what would they expect in a renewal increase, or what would the renewal look like if we were going from a PPO to reference-based? I mean, are you able to answer that in somewhat, or have you seen that before?
We've seen increments of savings second year going into the after the first year performance and second year renewal of anywhere from 5 on the low end to 25 to 30 on the high end.
So would you say that basically you're not going to probably see that in a change in your stop loss within that first year that you make that change?
The hard part, if it's straight reference-based pricing, meaning you're using the hospital and the physician network under that reference-based pricing model, you'll see savings first year, definitely. The trouble lies where you are using a physician network in conjunction with the hospital, and even though it's only 30% of the claims, you give up a lot in discount for that 30% going from, let's say, Cigna to PHCS. And so there's where you lose the savings. But the real exposure for you is on the hospital claims, so that's where you're going to make that up in the end. So.
And it's extremely important to make sure that you leave enough lead time to communicate with the employees and their families, their wives and their spouses, because if this is not implemented, they need to buy in on this. So it's a process, and that's the way it works best.
Yep. All right, let's maybe a different subject or
Just real quick then, if you see this helping employees and employers, is it going to be hurting the facilities? And if so, what are they going to do? What do you see them doing to combat this concept?
I'll answer that just for myself and get your perspective, but talk to Craig, because he has developed a model through which greater efficiency and higher quality means better care for patients and lower costs for employers. So hospitals aren't going to have a choice but to become more competitive, because this is what's happening. I mean, we've just spent the first 10 minutes talking about nothing but reference-based pricing. Hospitals don't want that, right? I'm thinking. But that's the reality of the marketplace. So they have to be more efficient.
And to piggyback that point, I think it's important to have a program that's going to be proactive instead of reactive, meaning that there's provider engagement ahead of the fact instead of we're just going to cut it to the lowest percentage of Medicare possible and just see what happens. We'll sue the hospital. I don't think that's a good model. So that's just my...
Yep. Yeah, the old crash and burn or the scorched earth policy. Craig, you had...
No bueno.
I will tell you, in Indiana anyway, Indiana University Health is purchasing hospitals on a daily basis. They own a number of facilities all throughout the state. You can't have an attractive PPO option if there is such a thing without IU providers in your network. And they have recently sent out a letter to all of their brokers suggesting that they will not accept RBP reimbursements as payment in full.
Wow, that's amazing. Vic, did you have a question before? I saw you raising.
I feel a little bit like a salmon here because of the scheduled benefits that we have. And I understand all the cost containment programs that are available and why they're being pushed and the shifting in cost to employees, some of them. And you pretty much hit the limit of that. But one of the comments I wanted to make is and thanks to Cypress and thanks to my broker Pam, who happens to be right here, and also Optum for the rebate program based on experience. Because I'm happy to say that they're going to be delivering a check to our company for $50,000, right? Rob?
Right, Rob.
It's in the mail. Yeah, first it's going to me, and then what's left over is coming to you.
But the point being is that even though, we are somewhat unique in where our scheduled benefits works, that we had the confidence of yourself to underwrite us. Because there were other times where certain people in the panel would say, don't even talk to that guy. So just a thank you, and just FYI for everybody else.
Well, thank you very much for that. But
how much you pay him, Rob? You buying dinner tonight?
Yeah, exactly. Yeah, exactly. $50,000. But Vic had brought up a question before that they are a little different, that they have no pre-cert. So it is a little different group. But again, things that do hand in hand with Cypress is to do these types of things that when you have this good experience, then there's actually a refund to your specific premium. So thank you for mentioning that, Vic. I appreciate that.
The transplant carve-out has been in place now for a couple, 3 years from a lot of places. And I know originally they said that, those of you that we talked to said that there would be some discounts for that particular, if we had that in our plan. Are you finding that that's worthwhile? Will those discounts be increasing? And also the question would be if when we use something like Renologic, is that going to be considered too?
I think all of these programs are reflective in your claims experience. If you're using a program like Renologic, your monthly claims experience, which is evaluated at the time of renewal, is going to show the savings, and therefore your renewal will be based on that. As for transplant programs, I know we're definitely in favor of them. As they get more and more expensive, it's a benefit to have. I'm sure everyone up here offers discounts for having a transplant program. Some do first-year discount, and then a second-year discount may be stronger because you don't have to worry about people being pre-X'd out or in a waiting period. But I know Barden is definitely pro-transplant program.
Yeah, we actually, at Optum, we have a fully insured transplant product. There actually is no pre-X in ours, so we give a discount, it's standalone. We give about a 4% discount to our stop-loss premium when that's put in. A little less with AIG since they do have the pre-X, but it's something that, like you're just saying, for minimum lives of 50, for I think all the groups that we have in this room, it's something that you should look at. I mean, if you have a laser coming up because of a transplant, you can avoid those types of things. The discount you're going to get from stop loss, everybody's going to be a little different. Like I said, we're about 4%. I've seen as much as 6, 7, 8%. And I think that's really, again, each carrier is going to look at that information and say, how much is it worth to my block of business, or maybe they're going to grade it according to what the specific is. But absolutely, it's something that you should at least be looking at, I'd say year in and year out, on if you're a broker, all your self-funded groups, and then if you're actually an employer group, something to consider. You can put it in any time of the year. You don't have to be on anniversary.
Yeah.
All right. Justin's got one. Right behind you.
Thank you. So I wondered if you guys could address the concept of leverage trend, because particularly at renewal time, I know we have a lot of clients that we talk to that are really hesitant to increase spec levels. And I think it would be beneficial for everybody to understand from you guys how employers should be looking at that towards renewal time, and just what leverage trend is and what it means.
Do you realize you just asked a question of a bunch of sales guys
Yeah.
about leverage trend?
Yes.
Yeah.
Leverage trend
That's
is-
maybe the worst question in
But
the
I do
history
think
of this
from
place.
from a cost management standpoint, relative to managing risk, I think it's important.
The concept of leverage trend means that the same claim that would happen in 2016 versus 2015 is going to have the effect of inflation on it. So as your time goes on, you need to increase your specific deductible to keep up with leverage trend, which also helps you mitigate the premium increases that you would get from medical inflation. That's a very simple way of explaining it.
I think another point that's always overlooked is if you have an aggregating specific on your group, when you come up on renewal, if you're not increasing your aggregating specific, your premium increase is going to feel heavier than it really is, because your aggregating specific, most of us, dollar for dollar, if you're not increasing that as well, that part of the increase is built into the premium. So not as well as increasing your spec deductible, you should also be considering increasing your aggregating specific to mitigate your increase in premiums.
Yep, Pete.
Yeah, if I ever use trend, then I've got no other excuses, and that's what I'm going with. No, but seriously, if it's based on our manuals, we need to get a certain amount of premium for the risk at hand. And so one of the biggest things that happens over time is if you're a good risk and year after year after year, we're giving you a 1 to 2% increase and we're fighting against leverage trend, by the 5th year, that means that I'm simply not getting enough premium for the risk at hand, okay? And so that means that even with good experience and clean risk, I might have to come out on the 5th year with a 30 to 40% increase, because I can't continue to deliver the single-digit increases year after year and fight leverage trend because my manual is just too low. Does that make sense? So we have to actually turn away groups with great experience just because we're not getting enough money now for the risk on the plan. So.
And the concept, I think the definition of leverage trend would simply be that the effect of base trend on the entirety of a claim has a greater effect than the excess amount of the claim from one year to the next in excess of whatever specific deductible we're talking about.
One of the things the ACA didn't do is address cost. And there's still medical inflation, even though it's been mitigated a little bit, there's still cost. And I believe that the reference-based pricing is a way for all employers to figure out a way to kind of fight the cost that's coming up, because if it continues to rise, sooner or later the legislature is going to step in. And so this is a way for employers to actually kind of fight that.
Anyone on this side of the room have a question? Or I do have a quickie. It has to do with drugs, because I saw a statistic recently that showed that specialty medications could ultimately, within the next couple of years, be 50% of overall drug spend. A two-part question. Number one, what do you suggest these people do about that, as someone who's ultimately going to be on the hook?
Exclude them.
Well, and which is number two. It's a great segue. Can you justify excluding those specialty drugs, and or are your contracts ultimately going to exclude those things? Can you imagine a scenario where that happens?
Well, first of all, everything in any plan is driven by the SPD, or the plan document. So the plan document would have to address that. But I think the FIA group would tell you, because they've told us, that you can exclude them.
You set preset language in the contract in reference to specific drugs, meaning like for superstatins, for example. One of the things that scares stop-loss carriers the most is, you got 35% of everybody in this room probably using a superstatin or a statin in one form or the other. And when superstatins become part of the plan, that's going to increase the cost twofold, especially for prescriptions. So you need to identify that in the plan document so that you're limiting your exposure again. By the way, people have great results using statins, and unless you go through a certain protocol, you shouldn't be eligible to have or use a superstatin, right? So that's just one drug where I know that's a concern. But so,
Jonathan,
yes, the plan document, you need to adjust it.
All right, cool. Jonathan,
Yeah, I was going to go ahead of the youngster. So one thing I was going to add on to that is that I don't think that we're going to be excluding anything. I think it's that we're going to underwrite the risk that's there, and it's going to be something that underwriters are going to take a look at. So if it's a certain drug that's out there that's expensive, they're undoubtedly going to say, okay, does this person have a certain diagnosis that can lead to that? And we're going to rate for it. Or, something that's been fairly recent is the LVADs, the left ventricular something. It's an artificial heart. So it's something that we know about, and we know if someone has congenital heart failure that they could have an LVAD. It's $1 million claim. So it's not as if we're going to exclude it. It's something that we're going to underwrite for. So it's kind of a two question of what we're going to do as opposed to what employers are going to do. Yeah. But exclude it or put a limit on it. But again, we're going to react to what we're being asked to cover.
One interesting thing that we've seen is basically a specialty RX specific utilization review product. I suspect that you're going to be seeing a little bit more programs like this in the future, but essentially what it is it gets down to the member level to determine whether or not what the physician has said they actually need is really necessary, if there's perhaps some other course of treatment that can avoid the $90,000 annual specialty drug. So that's one thing that we've seen.
Maybe Optum can create a specialty drug carve-out policy for all of our clients.
Sure, yeah, I'm on that, Craig. I got it.
There you go.
I know our director of claims, she monitors specialty drugs and what comes onto the market, and we update our documentation internally, and I'm seeing emails once, twice, sometimes 3 times a month with a new drug being added with the expected costs. And it's a little daunting when you see the numbers that are coming out, but we like our underwriters and our entire staff to be aware of what's on the horizon so that we can identify these and help to educate ahead of time so that it's not reactive, it's trying to be proactive.
And when I said exclude them, I didn't mean you never pay for them. That just means as they come up and they get into your population, you deal with your pharmacy benefit manager, Cypress Benefits, and you figure out a plan to make sure it doesn't kill the plan and also helps the individual.
All right, there's one right in the middle out there.
As more and more small employers get into the market, can each of you kind of tell me what your limits are? How low will you go so far as population for a stop-loss contract?
Maybe we can go right down the line.
I'll start here. We go down to 20 employees, and we have two versions of what's called the level funded product, but it starts at 20.
Optum is 50.
We go down to 25.
25.
We're obviously bound by each state's mandates, but we will underwrite, presuming that any given state will allow us to do so, down to 11 lives for both our traditional and our transitional, which is our level funded stop-loss product.
25 for us.
When we got proposals back this year from various stop-loss carriers, one of them had a laser not on the person, but on the fact that if that person would choose to take the Hep C medication. So it was putting a laser on a medication as opposed to be putting it on a person. Are we going to see that coming forward?
I think we like to call that a conditional laser. It's done for medications or for certain cancer treatments. It's when you know you have an individual who's quite possibly going to have a treatment. With your situation, there's obviously two clear choices of treatment, one of them being very costly. To answer your question short, yeah, we're probably going to start to see that more just because the cost of these drugs just keeps going up, and we have to be able to underwrite the risk appropriately for the risk takers and for our carriers. Otherwise, we won't be able to be here to provide coverage for you.
And let's just take a minute and talk about lasers. They were really developed by employers. I've been doing this since the early 80s, and there was no lasers when I first got into this business by anybody. But what happens is, as claims trend went up and claims and treatments got more successful, more expensive, you'd end up with a load to premium on a potential conditional thing because the carrier was going to have to do that if the risk happened. And then the employer would say, well, what can I do to mitigate this? Well, you can take an individual specific or individual laser on this person. And that's really how these things developed. And it's a tool to help mitigate risk.
So follow up on that. Right down the line, lasers, good or bad?
Good.
Generally in favor. We did a laser study a few years ago, and you'll typically find that, less than 50% are actually going to hit that laser amount.
Is that everyone's experience with that? Less than 50% of the time your lasers actually hit?
And let me do a quick story. A couple of years ago, we offered on renewal 2 lasers or a premium option or the 12 easy payment plan. And the client said, I want the 12 easy payment plan. 2 months into the plan, they called back and said, these 2 people are off the plan. Can I get the lasers? I'm like, no, sorry.
Yeah. To answer your question, lasers, intimidating and scary for employers, but overall they're good.
Bad.
Yeah, for me, it's situational, right? You want to have options because there's obviously situations where you got a very sick person and they're going to be not going to make it 3 months into the policy, or you definitely want to take the laser because there's no exposure to your deductible. So definitely situational, and it's always good to have multiple options. And by the way, ask Cypress to ask any of us to give us our opinion on the claimant. Understand how we view it, so you can make a more educated decision on what you want to do going forward.
We got something going on out here? Yeah.
Just a comment before you're talking about the organ transplant policies, and I highly recommend those. Even though we have a relatively good claims experience, it just so happens that it's as good as it is because we did have a carve-out policy. We put it in place, and it wasn't with Optum, by the way, everybody else, it was with somebody else. But 2 years after that, one of the principals of our company had to go through a major transplant process, and yet it responded very well. And the managed care, he spoke highly of it. But the point I want to also make, and just as a comment as an employer, is I understand the need for the laser, I understand the underwriting the risk and the underwriting specialty drugs. But at the same time, as an employer, will have to look at somebody and say, are you going to pay for this? And the whole purpose of the insurance plan is to take that issue away from my employer and his family, or my employee and his family, so they can concentrate on doing what they do for a living. And they can be just relaxed and comfortable that somebody else is taking care of them. Just a comment.
Appreciate that.
You did a great job in explaining it. Anytime you can take away a segment of risks on your plan and hopefully have the same amount of premium, I think it's a great thing. most of the transparent products are community rated products. They're pool products. So you essentially could have one claim that you're be a transplant that's 100% covered by the pool product, and not have it affect your traditional stop loss renewal, right? And you're going to get a 30% increase on that small premium, but it's relative compared to what you would have gotten had you had all the risk on the traditional plan.
All right, we got one on this side of the room finally.
I guess I'm just a little shocked that 5 out of 6 of you said lasers are good. I guess wouldn't it depend on the right language? So no new laser, second year rate cap, and then really up to the employer who ultimately knows that risk. So they may know that they're terminal, and wouldn't they kind of probably tell you that? So, I mean, again, we have clients that have lasers in there knowing that, you know, the risk is probably not there. And then, but for the most part, I would say 95% of our business has the no new laser second year rate cap. So I'm just a little confused that 5 out of 6 of you on the stop loss, and I see your point of view that they're good.
Well, I said it was a tool. It's a tool that really employers developed. They would come to us when you have a risk. When you have a known risk, stop loss is for the unknown risk. It's for something that you're not aware of. When you have a known risk, it has to be calculated into the renewal. So it's just a tool. Now, the no laser, I would love to put like 10% across our entire block and just go no lasers. But my competition here would just eat me up with, say, 10%, don't do a laser contract. If everybody on the planet could agree to no lasers, I think we could do it, but it's going to cost more money.
That would be collusion. Great.
Yeah, I mean, I think to Peter's point from a few minutes ago, I think he said it probably best. It's all about having options. I mean, we can quote with the laser, you can quote a no new laser product. So we'll give you those options to make that educated decision, obviously.
So, Greg, you're the one who said bad. Can you expostulate on
I did
that?
say bad, and I said bad basically for that reason that the gentleman just raised. I would say that lasers are good if the only two options that you as an employer or your client, your employer, has are a laser for the expected cost of a claim, or a premium increase equal to the amount that needs to be priced in accordance with the expected cost of that claim. However, if you do pool across your entire block, the fact that you don't laser, yeah, you're going to give that client a greater rate increase. And everyone's definition of fair is different. Fair is different when you've got a clean renewal than fair is when you've got a really ugly renewal. I would say that the fact that we don't laser and we do offer what I would say are fair renewals. You might say that my renewal increase on a clean case is unfair when you've got 15 other carriers that are willing to quote that same piece of business. But when you don't have anyone else that's willing to quote that piece of business without a laser, I think you would say in all instances that our rate increase is very fair.
I think one thing to keep in mind regarding lasers is it's actually just because of the way the market treats them, it's a benefit to the client in the sense of when you have a known condition and you laser it, I'm going to guess the majority of stop loss vendors, they say, okay, this treatment's going to cost $200,000. It's a $200,000 laser. Essentially, you're getting a $0 spec deductible on that individual. If you have a $75,000 spec deductible, the true laser should be the cost of the claim, the expected claim, on top of the spec deductible, because that's what you're purchasing as a group. However, the market just won't support that. So when laser is being placed, you're essentially giving a $0 deductible to that person. I understand that's not any kind of, you know, oh great, we're taking a laser and it's going to cost us this much more. But that is something that just the market doesn't support it otherwise.
We do write a lot of smaller groups. And I was talking to a couple of people earlier today, and I would say that, you know, there are large employers who are on the verge of bankruptcy who could not afford a laser. There are small groups with great cash flow who could afford a laser regardless of the size much better than a large employer. So size is to some degree a misnomer when it comes to what we should or what we should not do. But bottom line, we do write a lot of small groups, and a laser equal to some of the ongoing claims that we're seeing in today's world could easily bankrupt some of those accounts, and we're not willing to go there.
How we doing? All right, we got one down there. But we need a microphone.
We've heard a lot about wonderful cost containment programs from Host Care and others. How are you guys going to address that in the future?
Be more specific.
Well, from how will that be? How will you rate that in what we do going forward in quoting?
The majority of those benefits will reap rewards in the claims experience. I mean, we will give little token discounts for this program or that program, but the real benefit is that the claims cost will go down, and you'll hedge against inflation.
So on the front side, though, too, we'll see something.
You can, yes, absolutely, depending on the program and how well we've been able to evaluate it and have a relationship.
Okay, thanks.
We talk about this every year at the panel about our total loss ratio involved with Cypress in general, and that's in part because they are bringing the best-in-class vendors to the table. It's included in your partnership with Cypress, and so we know that when we're underwriters are quoting business for Cypress, they can get more aggressive and be, lower than in general with our other partners because Cypress is doing the things that we know on the back end are controlling our top end costs, right? So. And that's with any relationship. When you have good loss ratio, the underwriters get more aggressive. Where if you have experience that's not favorable, well, they're not going to be as aggressive when you underwrite the product. So.
And can I just follow up on that point because I think this is going to be self-serving, obviously, but damn it, I'm going to sell Cypress for a minute. Our loss ratio among our entire block of business, tens of millions of dollars across all of our stop loss carriers, 51%. 51%. I guess I've got two questions for everyone on the panel. Number one, how's that compare to what you're looking for? How do you define a successful year for loss ratio? And number two, for those people who are either not Cypress clients that may be in the audience, or the the brokers and consultants who may not be doing business with us personally, or currently, but are looking to, how relevant is a TPA's ability to control those kinds of things when it comes to stop loss?
Go ahead, John.
I'd say it's incredibly relevant. I'd say that Cypress is easily overall, in terms of the entire relationship we've ever had with them, it's probably consistent with that 51% figure. So it's critical that you have a TPA in place like Cypress that goes above and beyond to manage your day-to-day costs, because ultimately that's going to impact everything from renewals, possible lasers, things like that. So.
And I can't speak for the other carriers here, but we've had a couple good years, but frequency versus severity, and that means how often a large claim is going to happen in a population, could creep up at any time on any of us carriers, but the last couple of years have been good.
Yeah. Okay.
We kind of consider, you've heard about captives during this two-day conference, and we kind of consider our relationships with our TPAs to be similar to that captive type of arrangement. In other words, they're their own little captives, and some not so little. And I would say that Cypress is well outperforming most, if not all.
Yeah, to put that in perspective, the reinsurers control our business. And if you talk to any reinsurer, their carriers are getting 10 to 15 point margins on a net basis any given year. That's a nice year. So when you talk about net loss ratios in the 50% range, that's outdoing the market by a good 30%. That's good.
I think one thing to consider is along the lines of what Chris said, where 51% is great, and the benefit of that is when you do have a bad year, like Greg said, we're looking at the entire block of business we have with the TPA, and if you historically run well every year, and then the big claim happens, it's not going to adversely affect as much as a TPA that runs a lot higher, a lot hotter with more severity and more frequency. So they're doing a great job controlling costs, and it's benefiting with the relationships of the carriers up here on this panel, because we work with them, we have the relationship, and when they call and say, look, we need this, and here's why we need it, the chances of a yes are higher than 51%.
Absolutely.
I have another stupid comment, and something you guys probably won't need or will see behind the scenes, but when we refer to our TPA partners, we say Cypress runs a tight operation. In the 6 years I've been doing business, we never get the call and say, hey, we forgot to add this person to HIPAA, or forgot to offer COBRA, and there's a 30-day window and there was a claim. Can you make an exception? Can you make an exception? There are some TPAs that we work with where we get monthly exception requests, and in 6 years with Cypress, I don't think we've ever had a request for one exception. And that's a really great testament to the quality of organization that Cypress is.
I'll probably say too that probably the same thing with everybody else up here, that we're probably looking at probably about a 20%, if not a little bit more, regarding kind of where our block of business is on average and where Cypress is at 51%. So I'd say it's probably about the same for everybody, that, yeah, your loss ratios are great.
Yep.
All right. Awesome. See? Okay, we've got 2 minutes, and Marcia made me promise to ask this question. Advance funding. For those of you who don't know, advance funding often exists in stop-loss contract, most, I guess, wherein it's a cash flow kind of thing, where the stop-loss carrier will advance fund a very large claim, so you don't have to do it and get reimbursed. Marcia, do you have any other, like, sort of fill in the blanks on that question?
Well, I'm a fan of advance funding, the way advance funding was 20 years ago, where we had a claim, we knew it was going to hit a check run. The employer didn't want to fund it because it was hitting their spec. We'd send it to you guys, and you'd send us the money in 2 days, and we could release the check run. Now it's more like 4 weeks, 6 weeks for advance funding. We're losing PPO discounts. I'm not happy.
Yeah.
Which
is not a position you want to be in.
Specific claims that, I don't know if you were looking at me or all of us, but.
No, all of you. I mean, the
Chris, I think
advance
she was
funding
only
is
looking
not,
at you.
it's taking so long. And I know now I think there's more review on the claims on your ends, but for us to get that money so we can get it, the check runs released and get the payments out to the providers and not lose a PPO discount.
Well, Marcia, it shouldn't take that long. So if it is, for me, I think I speak for all of us, you should let us know, because that should not be happening. But it was created, all stop-loss contracts back in the 80s were reimbursement contracts. Probably everybody knows that, where you would actually have the employer or the plan fund the claim, and then it would be submitted to the carrier for reimbursement. And probably in the late 80s, the specific advancement was a rider that's on all of our policies, meaning that the employer just funds their portion of the specific, and then the claim's submitted to us, and we reimburse down to that specific level. And that's what she's talking about. And we try to do it on a timely basis.
Well, so you've been served notice that...
Well, and one add-on for that is that, yeah, exactly, I'll ditto that it should not be taking 4 to 6 weeks, but one other thing that we can offer as well is doing ACH of claims, so it's a direct deposit instead of doing a paper check to you, paper check back out to the employer group. We can do ACH, so it's just like direct deposit into...
Mandatory. That got to be doing that. It's mandatory at this point. That cuts 10 days off your claim check right there. Definitely wire money. If you're not doing it today, you should sign up for it.
I would hope that's not happening with us, but if it does, we will we'll support the lost PPO discount in the claim.
And the other thing is, too, we're competing against fully insured markets that are going out today. So, I mean, we, as an industry, we need to really pay attention to that and get that down to, as Marcia said, 3 or 4 days or whatever that is,
Right.
because that's what the Blue Crosses of the world are doing.
Yeah.
So,
All right, well, we've run out of time, but obviously these guys are here around the table, and we don't want to cut into table time. So talk to these guys and learn more. But in the meantime, thanks.
Thank you, Tom.
All right.